In this clip, I am going to explain the difference between accounting profits and economic profits. To start, let me define profits as total revenue minus total cost. You have seen this definition before. In fact, total revenue is very simple to figure out because it's essentially what we call in other textbooks, total sales. In other words, multiplying P times Q. This is important because it's related to what later we're going to study as the demand curve. So in order to make this a numerical example, let's suppose that you are in the pizza business and that here you have a demand curve for the pizzas that you produce and sell. Now, let's suppose that right now, on a weekly basis, you are able to say charge $10 per pizza and that you are able to sell 1,000 pizzas per week. So if you multiply P times Q to calculate total revenue or total sales, you can easily see that every week you are making $10,000. So that's the easy part. That's the relatively easy part because, well, there is no difference between accounting or economics. The difference comes from this second element in the definition of profits. Why? Well, total cost first is going to include what we call explicit cost. Now, these include all the production cost of pizzas, cheese, tomato sauce, pepperoni, electricity, etc. So let's suppose that every week you are spending $9,000. Therefore, in order to calculate your accounting profits, all you need to do is to subtract from your total revenue of $10,000 the $9,000 in explicit cost, leaving you with an accounting profit of $1,000. So this is great. Every week, according to your accountant, you're making money and depositing $1,000 in your checking account. In economics, we see this in a different way because number two, economists also include in the calculation implicit cost. These are the opportunity cost, which essentially are defined as the alternative use of all these resources that right now you're using the production of pizzas, but you are giving up. So let's suppose, for example, that here you are not taking into account a very important implicit cost, which is the value of your time. Let's say you could be working somewhere else rather than producing and selling pizza, and then you could be making $2,000 a week, right? So this is important because now look, if you calculate economic profits, you have to subtract, once again, from your $10,000 of total revenue, the explicit cost, $9,000, but also you have to subtract your opportunity or implicit cost of $2,000. This is going to give you with an economic profit of minus $1,000, which essentially indicates that you actually would be operating losing $1,000 per week if you pursue the pizza business. Why? Because look, if you produce and operate this pizza business, you are going to be making $1,000. But if you instead work for somebody else or in a different industry, you could be making $2,000. The difference is precisely what we call economic profits. In general, you are going to find that accounting profits always are going to be larger than economic profits because economic profits include both explicit and implicit cost, while accounting profits only includes this, the explicit cost. From now on, we are going to assume in this class that every time that we talk about profit maximization, we are talking about economic profits, not accounting profits. This is a managerial economics class, and we are going to be using this concept, economic profits. So there you have it, the difference between accounting and economic profits using this very simple example. I hope it's clear, and if it's not, please let me know, email, posting on the board, or contact me during office hours. All right, I will see you in the next clip.